GCDT presents us with a massive, and I mean absolutely massive, contradiction. On the one hand, their revenue just jumped more than 51% in their latest fiscal year. That's huge. But on the other hand, the stock has completely collapsed from its IPO valuation. Today, we're going to unravel this financial mystery by following the numbers directly from the company's SEC filings. So, let's dive right into this explainer and figure out what is really going on beneath the surface of this decarbonization company. Just take a look at this bizarre contradiction. GCDT went public at $4 per share, right? But by August 24th, the stock was trading at roughly 36 cents. That means the company's market cap plummeted from $50 million all the way down to just about $4.7 million. We're talking about a devastating 90% decline here. Yet, the company's revenue didn't shrink. It actually shot up by more than 51%. So you have to ask yourself, why on earth is the market treating a rapidly growing business like it's completely failed? Well, to answer that, we're heading into Section 1, the revenue contradiction, following the money. We really have to start by following the cash and seeing exactly where this top-line growth is actually coming from. Now, looking at the revenue history alone, it's honestly one of the strongest parts of the whole GCDT story. For fiscal 2024, they reported about 5.24 million Hong Kong dollars. Just 1 year later, that tripled to 16.57 million. And in fiscal 2026, it climbed yet again to 25.05 million. That's where we get that impressive 51.1% year-over-year growth. Basically, the company provides energy-saving solutions using phase-change material thermal energy storage technology. Think of them as systems designed to store thermal energy to shift cooling or heating loads for HVAC systems. So, on paper, it sounds exactly like a rapidly scaling high-tech platform, right? But wait, here is the big catch hidden within that fiscal 2026 revenue mix. A massive 68.5% of it actually comes from construction services, with energy-saving services just making up the remainder. This distinction is absolutely crucial for how we should value the business. See, GCDT is not some software company sitting back and collecting high-margin recurring licensing fees. Not at all. They operate a really project-heavy, construction-based revenue model. These kinds of projects require physical equipment, manual installation, and a ton of working capital. Knowing this completely changes how we view that 51% growth, and it leads us directly into our next big question. Which brings us to Section 2, the profitability problem, the cost of growth. So we know the top line is growing nicely, but does this project-heavy growth actually trickle down to bottom-line success? Let's walk through it. Step 1 is our familiar 25.05 million in revenue. But moving to Step 2, after we factor in the cost of that revenue, their gross profit was only about 4.35 million Hong Kong dollars. That leaves us with a pretty slim gross margin of roughly 17.3%. And then, in Step 3, we literally hit a wall. Administrative expenses came in at 11.18 million. Think about that. Those massive admin costs completely wipe out that modest gross profit, plunging them into an operating loss. Finally, in Step 4, after a few other financial items, they're left with a net loss of 13.11 million Hong Kong dollars. To really put those numbers into perspective, let's look at the previous year. In fiscal 2025, their net loss was 5.98 million. But in fiscal 2026, it more than doubled to that 13.11 million figure. Guys, that is a 119% increase in net loss. So, that huge contradiction we started with, it's really starting to make sense now. Yes, revenue grew 51%, but the net loss deepened by 119%. Now sure, a young company can deliberately spend ahead of its growth. That happens all the time. But as investors, we need to see that this spending is actually building a sustainable future. And to figure out if it is, we really have to look at the actual cash. Let's turn to Section 3, the cash flow reveal funding the business. We need to dig a little deeper into the financial statements to uncover the absolute truth about how GCDT is keeping the lights on with these growing losses. The critical reveal here is their operating cash flow, which swung to negative 15.52 million. Get this, in fiscal 2025, GCDT actually generated a positive 5.05 million in operating cash flow. But in fiscal 2026, that completely flipped to a massive outflow of 15.52 million Hong Kong dollars. That's a total deterioration of over 20 million. You know, having revenue is great and all, but cash flow tells us whether the business is actually funding itself through its own operations. And right now, GCDT's operations are just burning cash, not creating it. Now, you might be wondering, if they're burning through so much cash, how are they even surviving? Well, at the end of March 2026, the company's balance sheet did report $36.31 million in cash against just about $7 million in bank borrowings. Sounds pretty reassuring, right? Until you realize exactly where that money came from. During that same fiscal year, the company raised roughly 77.47 million Hong Kong dollars through its IPO. So that solid cash reserve didn't come from happy customers paying for services, it came straight from financing and selling shares. And that harsh reality introduces a massive threat for anyone holding the stock. Which brings us to Section 4, the dilution risk. Who pays for capital? If a loss-making, cash-burning business constantly needs more and more capital just to survive, we really have to ask who ultimately pays for that. Spoiler alert, it's usually the existing shareholders. Back in July 2026, GCDT agreed to a highly complex financing deal. It includes a $10 million note, plus warrants that can be exercised to create over 30 million brand new shares. And on top of all that, they set up an agreement to potentially sell up to $100 million of ordinary shares. For a company with a market cap of under $5 million, having the capacity to issue this much equity is a severe, almost existential threat of dilution. If a company repeatedly raises equity at a tiny valuation, the existing shares can lose their economic power incredibly fast. And sadly, it's not just economic power that existing shareholders need to sweat about, it's voting power too. In August, GCDT suddenly shifted to a dual-class structure. Under this new system, ordinary Class A shares get exactly 1 vote per share. But the 6.36 million Class B shares, they carry 50 votes per share. Basically, this means ordinary shareholders are the ones bearing all the massive economic risk of this cash burn and dilution, but at the exact same time, they are totally losing their voting influence over major corporate decisions. It's a really tough spot to be in. Then we have to mark October 7th, 2026 on our calendars. That is when a 1-for-6 share consolidation becomes effective. Simply put, every 6 shares will be consolidated into 1 single share. Now, it is super important to understand that a share consolidation changes the quoted share price and the total share count, but it absolutely doesn't magically create any new economic value. If you owned 600 shares before, you'll own 100 after, but your overall slice of the company remains exactly the same. Sure, the consolidation might lift the stock price out of penny stock territory, but it does absolutely zero to fix any of the underlying business metrics we've just been talking about. Let's move to Section 5, Customer Concentration, the 95% risk. Aside from all those tricky financial mechanics, there is a massive operational risk buried deep in the annual filing. Seriously, this brilliantly illustrates exactly why you always have to read the footnotes. In fiscal 2026, customer number 1 accounted for 48.47% of revenue. Customer number 2 accounted for 46.89%. Put them together, and just 2 clients made up over 95% of the company's entire annual revenue. This is an immense vulnerability. We really can't evaluate GCDT like it's some diversified industrial giant. If just one of those contracts gets delayed, finished, or simply isn't renewed, the financial shockwave to the company would be catastrophic. That amazing 51% growth story we started with? Yeah, it suddenly looks a whole lot more fragile when you realize it's basically balancing on the shoulders of just 2 major projects. All right, let's wrap this up in Section 6, the final verdict, bull versus bear. So, what does this all mean, and where does it leave us? Well, to be perfectly impartial, there is a legitimate bull case here. Their revenue really did grow a staggering 51.1%. They ended the year with over $36 million in cash. They're operating a technology platform squarely in the growing decarbonization and thermal energy storage space. And technically, their gross profits did increase. If management can figure out how to diversify that customer base and turn one-off projects into recurring demand, the market could absolutely revalue them. But we simply cannot ignore the bear case. They posted a $13.1 million net loss. Their operating cash flow took a brutal swing to negative $15.5 million. 95% of their business relies on just 2 customers, and their capital structure is heavily loaded with extreme dilution and control risks for regular shareholders. When you piece all of this together, the financial evidence strongly suggests taking a cautious approach. The data simply does not justify treating this as a conventional, high-conviction growth stock right now. So we're giving it an investigation rating of watch. For conservative investors out there looking for proven profitability and a diversified revenue stream, GCDT just doesn't meet that standard yet. The issue isn't that they aren't growing, they clearly are. The real issue is that they haven't proven this project-heavy growth can translate into durable, sustainable cash generation without constantly leaning on new financing that dilutes the folks who already invested. Which leaves us with the ultimate question we need to monitor ahead of their next financial update.
Can GCDT actually turn growth into cash? As you evaluate this company, forget the headline revenue, forget the stock price spikes, and honestly, forget the share consolidation math. Operating cash flow is the single metric that will determine if this decarbonization turnaround is a genuine opportunity or if that falling stock price was simply an early warning sign. Keep your eyes glued to that cash flow statement because that is exactly where the real story of GCDT will finally be told.